So on this podcast, we're going to cover the business plan, starting with the executive summary. So I just wanted to do this in detail. I know we tried to do it in the previous podcast, but hopefully this one's a lot more focused. So starting off the executive summary, which is pretty much just a summary of the business plan as a whole. You'll see on page 1, it starts with the problem, which is the affordable housing crisis impacting about 5.25 million. I saw some numbers the other day that had it up to I think it was about 24 million people can't afford their houses, but I think this is severe cost burden, which is over 70% of their income. So 5 million people are spending 70% of their income on rent per month. And so the solution to that we've came up with is revitalizing distressed multifamily apartments. And so that's going to be more cost effective than building new apartments, because the structure's already there, but a lot of these apartment buildings only have about a 60% occupancy rate or an 80%, so it's not fully optimized. So obviously, if we could take these properties, make the renovations in some of the units that might not be rentable, and just kind of improve the property as a whole, I think that could really make a big impact into providing affordable housing for those Americans that are facing the severe cost burden of paying 70% of their income on housing. Anyways, the market for this is low to middle income families looking for affordable housing, and now we are specifically looking into government designated opportunity zones. So that would be like certain districts would be marked as an opportunity zone by the federal government. There's a lot of government subsidies for these opportunity zones, but these properties typically need improvements and are undervalued, and that's why the government says they're an opportunity zone. Anyways, geologically, we're looking in the Rust Belt of America, which was back kind of where industrialization started in America, but as time continued, investment went down in those areas, and now typically they're more poorer cities. Anyways, competition. Now, multifamily real estate has an extremely high barrier to entry. It costs $1 million to buy a new property. So competition is relatively narrow, but at the same time there is a handful of competitors in each of these communities that we're looking at. And they're all typically medium to large companies. None of them really have national attention for renovating apartment buildings and apartment complexes. Anyways, so how we're different is, we take a new approach to the concept of providing affordable housing. So our mission is to invest in undervalued urban apartment buildings, as I said, that typically, an investor or, an institutional investor would overlook, or even just a casual investor looking for investors or investments for their family. And we're different because we're willing to take the extra mile to invest in more of the property, but the local community, working with local governments, and influencing other businesses to come and build headquarters and invest in the community with us. So taking this extra step to invest in undervalued communities will, help these properties increase their value. So it's going to increase property values all around that area once businesses start investing in the long term in those communities. And then going down to expectations, the forecast. So we're expecting to acquire one asset our first year at about $4 million. So we'll get this, or we'll use the money we raise in private capital as the 20% down payment on the property. And then so income from renters will cover the monthly loan payment, and we're looking at about 150 to 200 units. So that's about $20,000 to $30,000 per unit in an opportunity zone. Anyways, our average rent will be about $650, and we're calculating this based off of 30% of an individual's or household's income at the average of 60% of the median average. So that's very confusing to say, but you just take the median average income, you multiply that times 60, and then you take 60 as their annual income, and then you split that into 12, and then which would be their monthly payments, and then you split that or you multiply that times 30%, and that will get the rent. So that's 30% of the lower income household monthly income. As again, that's just very confusing, but you just got to think about it. Anyways, we're anticipating about 90 to 95% occupancy per property. We will disclose, or we'll just tell you, what's the lowest we can go and still break even, just in case there's like a change in the rental market or something along those lines. Typically, it's about, I would say, still break even at about, 60% occupancy.
60 to 70.
Something along those lines. And then we're going to reinvest our profits as down payments on new properties. And so that's kind of one of the main reasons we're not offering dividends right off the bat, is because we want to grow the business as fast as possible. And so as you see at the 5-year financial forecast, we have not planned any dividends. But in the first quarter of 2024, I think is the 6th year. In the first quarter of the 6th year, we're going to sit down and we're going to reevaluate the whole thought process behind dividends, because at that point we will be at in an area where we're interested in offering dividends to our investors. And so, first quarter of the 6th year, we will sit down and we'll talk about that. Anyways, the financing needed, we're going to need $1,070,000 for our first year to acquire our first property. And so that's going to be a 20% down payment on our first apartment. The bank is going to loan us 80% of the loan. So here's just something to think about. A lot of people ask, how much money of our own money are we investing into this? First of all, we're investing as much as we can to get this the business set up, the legals, and paying people to help us out with analysis and stuff like that. Then we're also putting as much as we can into the apartment. But we're really getting, or the main reason that we're going to have so much equity in the business as founders is because we're going to have to put a personal guarantee on this loan, which means we're going to have about $3 million sitting over our head, and so that's one of the main reasons that we're going to obtain such equity without putting such substantial money down into the business at the beginning. Anyways, so going down to opportunity, this is kind of pretty much as we said in the executive summary. It goes into a little bit more detail about the affordable housing crisis, and the same thing with the solution, target market, and the competition. And so if we haven't mentioned the competition a lot already, pretty much our REITs, real estate investment trust, Fundrise, which is a online company that invests